I want you to imagine a scenario for a second. You're overseeing a multi-million-dollar business expansion.
Right across North America.
Exactly, across North America. Your product is completely dialed in, the marketing strategy is locked, and, the supply chain team is just ready to go.
Everything's greenlit.
Yeah. So you flip the switch, the expansion goes live, and suddenly
everything stalls.
everything stalls. Your internal audits start failing. Financial reporting across the border is just a total mess.
The warehouse is miscounting inventory.
Right. And when you finally track down the culprit, it's not a bad strategic move or a sudden market crash.
It's a single word.
It's a single word. Or maybe it's a capitalized letter where a lowercase one should be. Or even a truncated database field that cuts off exactly one character too early.
Which is wild to think about.
It is wild. Welcome to another deep dive. Today we are looking at something that hides entirely in plain sight.
It's the invisible architecture of our daily lives. I mean, we are talking about the underlying linguistic and structural code that dictates how business actually functions.
Things we frankly never think about until they break.
Until they break and cause a cascading failure, right?
Which is exactly why I wanted to tear into the stack of sources we have for today. We got our hands on a set of highly specific software development documents.
Titled USA Translations Localization.pdf.
Yeah, quite the mouthful. And if you look past that incredibly dry title, what you are actually holding are the absolute blueprints for a massive 2026 enterprise accounting software update.
An update explicitly designed to span the United States, Canada, and the unique regulatory environment of Quebec.
And the mission of our deep dive today is to uncover the hidden rules within those blueprints.
We're going to explore how something as seemingly mundane as, say, localized spelling variations.
Or typographical capitalization rules.
Right, or preposition choices in foundational database architecture. How all of that actually shapes the financial reality of an organization.
We're looking at how developers program regional empathy and compliance directly into a ledger.
Because whether you are a controller running a consolidation, or an auditor tracing a transaction,
or just someone trying to organize your own operational data.
Exactly. This invisible architecture directly influences how you perceive information. It dictates your decision-making process.
Once we unpack the sheer level of psychological and regulatory engineering that goes into a single drop-down menu or a chart of accounts, you're going to look at your software in a completely different way.
It truly is a masterclass in human-computer interaction. It's just heavily disguised as a routine accounting update.
I want to start with what initially seemed to me like the most baffling part of these developer notes. The sheer amount of resources dedicated to localizing the software for the US versus Canada.
The spelling schism.
Yeah, the spelling schism. My initial thought looking at this was, why bother? They both operate in North American English.
You'd think it's all the same.
Right. Surely, from a development standpoint, it would be infinitely easier to just force a single, standardized U.S. English interface across the board, change the currency symbol from USD to CAD, and call it a day.
Just let them deal with dropped vowels.
Can't the Canadian users just adapt?
You think so? But that approach fundamentally misunderstands the psychological relationship between a user and their financial data.
Trust.
What the developers of this 2026 update understand is that trust is the absolute foundational currency of any accounting system.
If you are trusting an enterprise platform with your company's lifeblood and it consistently spells core operational words wrong according to your cultural background,
It creates cognitive friction.
it feels like an imported generic product.
Or worse, it feels like malware.
Wow, yeah, malware.
Precisely. If an interface feels alien, you subconsciously begin to doubt the underlying mechanics.
And if you doubt the interface, you begin to doubt the math.
Exactly. To understand why a 2026 software update requires such meticulous linguistic separation, we have to look at the historical context that dictates these rules.
Going back to Noah Webster?
Noah Webster, yes. The United States underwent a very deliberate, systematic simplification of its language, largely led by him in the early 19th century.
The goal was to create an American English distinct from British English.
One that was more phonetic, highly logical, and culturally independent.
So Noah Webster was essentially rebranding the language for a new nation, and we are still dealing with the software implications of that rebrand centuries later.
We absolutely are. Now, Canada had a completely different trajectory. Because of its enduring historical ties to the United Kingdom, Canada retained the traditional British spellings.
But you factor in a massive shared border and constant economic integration with the US.
And Canada inevitably absorbed a ton of Americanisms. The result is that Canadian English is this highly specific, unique hybrid.
And software developers have to navigate that exact hybrid perfectly to maintain absolute user confidence.
Which is where those 5 rules of localization come in.
Yeah, the localization documents lay out 5 very rigid rules. The level of granularity here is just wild. The first one they tackle is the -R versus -SURE rule.
This is the most visible divergence.
Yeah.
The rule dictates that the Canadian localization must use the British -R ending for most words, whereas the U.S. interface systematically drops the U.
Right, so applying that to the actual software interface, if a user in Chicago opens their system preferences, the tab says colors, COLORS.
But the developer notes strictly mandate that the Canadian build must use string ID 3300.
Which spells it COLOURS. The mandate specifically flags phrases like, use colors for out of stock.
And it doesn't stop at aesthetics. It bleeds into the actual financial modules.
Favorite versus favorite in reporting dashboards.
Honor versus honor in legal and compliance modules.
But the biggest one I saw for the actual accounting workflow was labor versus labor.
That is where the cognitive friction I mentioned really hits the bottom line. Imagine a Canadian project manager or controller dealing with job costing.
Or running a massive payroll batch.
Right. If the module header says direct labor without the U, there is a microsecond of hesitation.
It's a tiny visual stumble.
But multiplied across hundreds of interactions a day, it causes profound user fatigue. The developers are legally and functionally required to swap that out for labor to ensure the workflow remains seamless for that specific geographic user.
It makes sense when you frame it around user fatigue, but then I hit the second rule in the documentation, and it goes beyond just spelling preferences into actual functional danger.
The -RE versus -SURE rule.
Yes, which deals primarily with words of French origin.
Canada typically retains the original -SURE ending. It reflects both its bilingual heritage and the historical British influence.
While the US, following that Webster phonetics model, flips the letters to -SURE.
So what a U.S. user knows as a center becomes a center in Canada.
Which seems harmless enough when we are talking about cost centers or profit centers in a ledger. A U.S. auditor looking at a Canadian subsidiary's books isn't going to be confused by cost centers.
No, they won't.
But the developer guide flags a massive distinction here around the word meter versus meter.
This is crucial.
In the U.S. build, METER covers everything. It's the device that measures things, and it's the unit of distance itself. But the Canadian localization has a strict bifurcation.
That bifurcation is mission critical for inventory and stock management modules. In the Canadian localization, a meter, spelled METER, refers exclusively to a physical measuring device.
A water meter, a gas meter, a parking meter.
Exactly. But meter, spelled METRE, refers exclusively to the unit of distance.
I was trying to picture the real-world fallout of getting that wrong in an enterprise system.
That would be disastrous.
Imagine a scenario where a manufacturing plant in Quebec is running a massive supply chain audit. The U.S.-based parent company pushes an unlocalized software update.
Oh, no.
Suddenly, the system is asking the warehouse floor to count the number of meters in stock for a cabling project instead of calculating the meters of cable required.
You aren't just annoying the user anymore.
You are actively corrupting inventory data and potentially halting a production line because the software conflated a device with a dimension.
And that is exactly why these localization blueprints are hundreds of pages long. It isn't pedantry. It is operational security.
The software has to reflect the physical reality of the user's environment.
Which brings us to the third rule, which the source material calls the Z agreement and the S exception.
This perfectly illustrates that strange hybrid nature of Canadian English we discussed. Because you would assume, following the British ties, that Canada would use the S everywhere, right?
Like the UK spelling of organize with an S.
Yeah. But the documents show that Canada actually sides with the U.S. on this one.
They do. Both the U.S. and Canadian enterprise platforms generally standardize on the Z. So you will see organize and parallelize uniformly across the North American build.
It simplifies the code base slightly for the developers.
But there is a glaring, massive exception that they have to hard code around. Analyze. Accountants and analysts use it constantly. This is where the hybrid rules demand strict manual overrides.
In the U.S. software, it is analyzed with a Z, But Canadian reporting standards absolutely mandate that Annalise is spelled with an S.
The developers have to flag this specifically for report generation strings.
The blueprints highlight strings like Annalise supplier returns or generating an aged Annalise report.
If a Canadian CFO hands a finalized financial statement to a local tax authority or an external auditor, and the headers use a Z in Analyze,
It immediately undermines the professionalism of the document.
it's a subtle tell that the system generating the data doesn't understand the local regulatory environment. And again, if the software doesn't understand the local reporting environment, how can the auditor trust that it correctly calculated the localized tax burdens?
It introduces doubt where there should be absolute certainty, which is a perfect segue into the fourth rule, doubling consonants.
This one felt incredibly tedious for the developers to execute.
When adding suffixes like dashed or dashing, Canadian grammar dictates doubling the final L, while the U.S. does not.
The primary example the blueprint focuses on is the word canceled.
In the U.S. ledger, it is one L.
But for the Canadian database, the developers have to hunt down and flag every single system response, error code, and status update that uses that word.
They specifically cite string ID 35305 and 3536, mandating they use canceled with two L's whenever referring to the status of a remittance.
They also have to update expense claim modules to say traveling with two L's.
And stock management modules to say labeling.
There's even a margin note about string ID 917.
Right, which is just a routine error pop-up. It literally has to be changed from backup process canceled by user to backup process canceled by user just for that one geographic border crossing.
The sheer amount of hours spent auditing string IDs for an extra L is staggering. And the fifth rule the developers note is essentially the practical synthesis of all this for the database architecture itself.
The mandate that technical errors, document statuses, reporting headers, and drop-down menus must flawlessly reflect this hybrid identity without dropping a single string.
It requires a QA process that is borderline obsessive.
Looking at all these historical quirks, the dropped vowels, the strict metric demarcations, the Z's and the S's, it really paints a picture of software development that is deeply anthropological.
They are studying the users.
Understanding the weight of their specific cultural history and writing that directly into the source code, they are programming empathy into the database so the user feels seen and protected by the system handling their money.
Empathy in the database is a brilliant way to phrase it. And what the source documents reveal is that this empathy extends far beyond just how words are spelled.
It also dictates how those words are visually presented on the screen.
Which brings us to a massive structural shift regarding typography.
The transition from spelling mechanics to visual hierarchy. The blueprints dedicate an enormous amount of space to overhauling the psychology of sentence case within the chart of accounts.
To fully grasp the magnitude of this overhaul, we have to contextualize it against the legacy of older accounting systems. For decades, the undisputed standard for financial software was all CAP-ES.
Every ledger entry, every report header, every interface menu was typed entirely in uppercase letters. I remember looking at printouts from those older systems. It felt like the software was just perpetually screaming at you.
It did.
Current assets, accounts receivable, petty cash. It was incredibly aggressive on the eyes.
That aggression was a byproduct of technological limitation. It was a holdover from the early days of computing, specifically systems like the AS400 green screens,
Where typographical options, fonts, and rendering capabilities were severely restricted.
the system literally only had one register. But as we move into the 2026 enterprise software landscape, the developer blueprints note a definitive, scientifically backed trend shifting entirely away from that all CAP-ES legacy.
The new standard they are enforcing across the board is sentence case.
Correct. Sentence case, where only the first letter of the first word is capitalized and the rest remain lowercase, with the exception of proper nouns.
Accounts receivable with a capital A and a lowercase r. I would have assumed that was just an aesthetic modernization, just making the software look more like a modern web app and less like a DOS prompt.
But the developers cite actual cognitive science here. They note that sentence case is empirically proven to be faster to read and process.
The cognitive science behind typography is fascinating, especially when applied to high-stakes environments like accounting.
When you read all SAP-ES, your brain is forced to work substantially harder to distinguish the individual letters. Because capital letters are generally the same height and lack varied baselines, they form uniform rectangular blocks of text.
Your eye has to decode the internal structure of every single block to understand the word.
Whereas sentence case gives words a distinct physical silhouette.
Right. Sentence case utilizes ascenders and descenders. You have the tall parts of a T, an H, or an L reaching up.
And the dropping parts of a P, a G, or a Y reaching down.
This creates a unique, recognizable physical shape for every single word. Your brain stops reading individual letters and starts recognizing the shape of the word instantly.
Now apply that to an accountant or a controller doing intensive data entry or staring at a bank reconciliation for 8 hours a day.
The cognitive load of decoding those rectangular alt-tip yes blocks for 8 hours would be exhausting.
It leads directly to severe eye strain, mental fatigue, and critically, a spike in costly data entry errors late in the day. By shifting the entire interface to sentence case, the software actively reduces that cognitive friction. It protects the user's focus.
But the developers didn't just blanket apply sentence case to every single field and call it a day. That would create a different kind of visual soup.
No, the blueprints outline an incredibly clever design rule that uses typography to create a natural visual indentation within the financial reports.
They leveraged the parent-child hierarchy rule.
In any robust chart of accounts, you have main accounts. The parent accounts the roll of the totals.
And then you have the nested sub-accounts beneath them that hold the granular transactional details.
The localization guide strictly mandates that all main accounts must remain in uppercase, while all nested sub-accounts must be rendered in sentence case.
Let's visualize what that actually looks like on a screen based on the examples in the source. Imagine a controller pulling up a sprawling general ledger.
At the top of the section, they see current assets in bold, all caps.
It immediately registers as an immovable category header. Then, directly beneath it, visually subdued by the typography, they see petty cash and operating account -CAD written in quiet sentence case.
Further down, another all-caps ad header, accounts receivable.
Followed by trade debtors and allowance for doubtful accounts in sentence case.
The analytical benefit of this typographic rule is profound. It creates a rigid structural hierarchy without relying on complex formatting.
Or artificial indentations or heavy UI elements that can break when exported to a CSV or a PDF.
When an auditor scans a trial balance, their eyes naturally skip over the sentence case transactional details, the noise, and immediately latch onto the all-cap PS headers, the signal.
They can instantly see the structural pillars of the business. The accumulating totals just pop out at them while the hundreds of sub-accounts stay cleanly in the background until they are specifically needed.
It's elegant.
It is. But of course, dealing with accounting and taxation, there are always vital exceptions to the formatting rules.
Always. The developers highlight that even within this strict sentence case mandate for sub-accounts, acronyms are the immovable exception.
Regulatory compliance supersedes typographical aesthetics.
Official tax and governmental terms must remain fully capitalized, regardless of where they sit in the parent-child hierarchy.
The blueprint explicitly forbids changing a subaccount to greased/HST payable with lowercase letters. It absolutely must be rendered as GST/HST payable.
The same applies to CPP/QPP deductions in the Canadian payroll modules.
The notes specify that altering the case on an official tax acronym can actually violate regional tax presentation standards. You cannot stylize a government mandate.
And exploring that intersection of typography and taxation brings us to a highly specific, very illuminating nuance regarding Quebec reporting that the developers had to solve.
Quebec presents a unique challenge because it operates its own distinct sales tax, the QST,
which runs concurrently alongside the federal GST.
I saw that in the notes. The developers used this exact parent-child typographic hierarchy to solve what looked like a massive reporting headache.
It is a brilliant piece of structural engineering. The source instructs the architecture team to create one main parent account called sales tax payable.
Following the rule, this is rendered entirely in uppercase.
Underneath that parent account, they nest the two specific liability subaccounts in sentence case, GST/HST payable and QST payable, Quebec.
So why go through the trouble of building that specific nested structure just for Quebec? Why not just list them as two separate equal accounts?
Because that specific structure serves two completely different masters simultaneously, without requiring the user to generate two different sets of reports.
Consider the internal management team.
When a business owner or a CEO looks at their balance sheet, they generally don't care about the granular breakdown between federal and provincial tax burdens.
They just want to look at the all-caps sales tax payable line and see one single consolidated number.
They want to know the total cash liability they owe the government.
Right, they just want the macro view.
Exactly. But when the external auditor from Revenue Quebec shows up to examine the books, that consolidated number is useless to them.
They don't care about the total.
They are legally required to audit the specific, legally distinct QST subaccount to ensure provincial compliance.
The uppercase and sentence case parent-child structure allows the software to satisfy both the high-level management reporting requirement and the granular government compliance requirement within the exact same ledger view.
It allows the software to speak two different languages at the same time, purely by manipulating capital letters.
It's fascinating how much power is hidden in the formatting. But if you think changing capital letters is an intense level of oversight, we need to talk about the terminology audit.
Yes.
The source documents reveal that the 2026 update includes a total eradication of a single, widely used preposition.
The great preposition shift. This is perhaps one of the most revealing insights into how software architecture is evolving.
The developer blueprints outline a systematic, unyielding removal of the word per across the entire software ecosystem.
Completely replacing it with the word by.
The developers refer to the use of per as a linguistic tick deeply embedded in legacy accounting software. For decades, if you wanted to analyze your revenue, you would run a standard report called sales per customer.
If you were looking at your supply chain, you would run purchases per vendor.
It was ubiquitous. But the 2026 audit demands that every single instance of per be hunted down and changed. Why is per suddenly persona non grata in enterprise software?
To understand the banishment of per, we have to unpack a fascinating philosophical divide between traditional European software architecture and modern North American user experience, or UX design principles.
In older, often European-designed legacy ERP systems, the word per was utilized as a very literal, almost clinical translation for the database concept of grouping or arraying data.
It was database logic translated directly into the UI.
Exactly. But modern North American UX philosophy operates on a completely different premise. The interface is no longer supposed to sound like a database.
It is supposed to mimic human intuition. And in that context, by is the undisputed intuitive standard.
Let's break down the logic the developers use here. The word by implies a sorting, filtering, or organizing function.
It feels conversational.
When you tell a system sort this list by date or show me sales by customer, it feels like a natural command you are giving to a digital assistant. It aligns with how we actually speak.
Conversely, the semantic weight of the word per has shifted in modern vernacular. To a contemporary user, pro almost exclusively implies a unit of measure, a ratio, or a division calculation.
When you see price per unit, 60 miles per hour or cost per acquisition,
Your brain immediately understands that a mathematical division is taking place.
So when a user navigates to a menu and sees a legacy report titled Report per Period, their modern intuition clashes with the legacy phrasing.
Exactly. To the modern ear, report per period sounds mathematically literal.
It sounds as though the software is going to generate one individual distinct report for every single period that has ever existed in the history of the company's database.
Rather than simply generating a single report and sorting the data chronologically, it creates a subtle but real moment of semantic confusion.
It's that cognitive friction again. The developers actually listed well over 100 specific string IDs that had to be audited, rewritten, and rigorously tested just to execute this preposition shift.
The meticulousness is incredible.
Sales per product is eradicated and becomes sales by product. Purchases per vendor transforms into purchases by supplier.
And in that last example, we can see a secondary terminology modernization happening simultaneously alongside the preposition shift.
The audit isn't just fixing the connective tissue of the sentences.
It is fundamentally updating the core nouns used to describe the business ecosystem.
I noticed that. The vocabulary of commerce itself is being updated. The audit strips out the somewhat archaic vendor or the highly clinical creditor and modernizes it to the much more collaborative supplier.
The adversarial-sounding debtor is softened and updated to customer,
The tentative estimate becomes a firm quote.
which means a clunky legacy software phrase like estimates per debtor, which sounds like something out of a Dickens novel, is transformed through this audit into the sleek, modern, actionable phrase, quotes by customer.
One of the most striking examples of this translation from database speak to human speak in the source documents involves a string for merging tax items.
The old legacy text, which users presumably stared at for years, was merge items per tax on ledger.
Which is practically unintelligible. It is technically ambiguous and structurally confusing.
It sounds like a machine translation that gave up halfway through.
The 2026 audit completely rebuilds that string. It becomes consolidate entries by sales tax code.
Look at the precision of that update. It replaces the vague, non-accounting term, merge items with the precise, JEP-aligned action consolidate entries.
And it replaces the divisionary, confusing per tax with the explicit filtering command by sales tax code.
It elevates the functional clarity of the entire module. The software is no longer forcing the user to learn its obscure database language.
The software has been rewritten to speak the user's language, but as with all absolute rules in software development, I'm always fascinated by the rule breakers.
In this massive system-wide purge of the word per, I scoured the developer notes to see where it actually managed to survive.
Where is it?
The word per survives strictly in the environments where its mathematical or formal legal definition is absolutely required.
The source blueprints specifically exempt ratios and physical units of measure from the purge. For instance, string ID 2377 is mandated to remain lines per inch.
Because in that context, it is a literal physical ratio. You are dividing lines by inches.
Correct. And it also survives in a very specific, highly formal legal context. String ID 3013 is protected. It remains bank balance as per bank statement.
Why did that one get a pass?
Because in the realm of auditing and financial compliance, the phrase as per carries specific evidentiary weight.
It is the legally recognized phrasing used to denote that a specific figure in the software is sourced directly from and matches an external third-party verified document.
If a developer were to change that to bank balance by bank statement, it loses that formal evidentiary tone.
It suddenly sounds informal, which is the exact opposite of what an auditor needs to see during a reconciliation.
Think about how deeply this impacts your own digital intuition. Whether you are using enterprise software, shopping on a massive e-commerce platform, or just organizing the photos on your smartphone, how do you navigate that data?
You search by keyword, you sort by date, you filter by location.
You would never intuitively attempt to search per keyword. This massive terminology audit proves how human intuition, the way we naturally conceptualize and manipulate our environment, is being rigorously, intentionally programmed into the interfaces we use.
They are actively aligning the database with the architecture of the human mind.
Which serves as the perfect transition to the next massive undertaking detailed in the blueprints. Because while the UX team was busy aligning the terminology with the human mind, the back-end engineering team had to completely re-architect the database itself to handle the sprawling reality of modern corporate structures.
Exactly. We are moving from the interface into the engine room.
The source documents refer to this back-end overhaul as the 5x3 database revolution. To truly appreciate why this is classified as a revolution, we have to look back at the suffocating constraints of legacy database architecture.
If you examine older software paradigms, early monolithic ERP systems, flat file databases, or early desktop accounting platforms, the actual database fields where a controller would type the name of an account were rigidly technically capped.
The system architecture simply couldn't handle long text strings, so the fields were usually locked at a maximum of 30 to 35 characters.
30 characters, which sounds completely reasonable until you actually try to type out a highly specific, complex business asset or liability.
The developer blueprints paint a painful, albeit slightly hilarious, picture of what this 30-character limit birthed: the decoder ring era of accounting.
That is the most apt description possible. Because accountants and controllers inevitably slammed into that 30-character wall constantly, they were forced into survival mode.
They began inventing incredibly confusing, highly esoteric abbreviations just to make the accounts fit into the system.
The source documents use a brilliant example regarding a depreciation account. A controller needs to log the depreciation for office furniture at the corporate headquarters.
But because of the character limit, instead of a clear, readable title, the ledger spits out DPRN-Furniture and Fixtures O, and it just abruptly cuts off right there at the 30th character.
The text just vanishes into the ether.
Oh, what? Office. Outdoors. Oregon. Operations.
If you were a new hire or an external consultant, you literally needed the specific employee who typed that entry to stand over your shoulder and act as a human decoder ring just so you could read the company's own internal financial statements.
And here is where the critical regulatory angle comes into play, which is ultimately what forced the software developer's hand to rebuild the architecture.
Under US GAAP generally accepted, accounting principles financial statements are held to a very specific legal standard. They must adhere to the principle of being clear and not misleading.
And a ledger full of truncated, cryptic abbreviations is the exact opposite of clear.
Precisely. If a corporation is undergoing a rigorous external audit, or if the IRS is conducting a review of the books, those external parties cannot be legally expected to guess what an esoteric cutoff acronym means.
Truncated, heavily abbreviated database fields fundamentally violate the spirit of full disclosure, transparency, and clarity.
An auditor cannot confidently understand the account metadata if half the descriptive text is literally missing from the system.
So the legacy software architecture was actively, structurally preventing the business from being fully GAAP compliant. That is a massive liability.
It was an untenable situation for an enterprise platform. So the blueprints reveal the structural solution engineered for the 2026 rollout.
It is an entirely new foundational template referred to in the code as the customized-empty-books-5x3-digits solution.
I know, customize empty books 5x3 digits doesn't exactly roll off the tongue.
But how does this 5x3 structure actually shatter that 30-character ceiling and fix the compliance problem?
It represents a brilliant, decisive move toward a highly scalable, modern relational database structure. Here's the mechanics of how the 5x3 logic operates.
The system breaks the account coding into two distinct segments.
The first 5 digits represent the main account, which is also known in accounting as the control account.
So, for example, the code G1000 serves as the main account for all debtors,
Then, appended to that, you have a 3-digit suffix that represents the specific subaccount.
which mathematically gives the user the capacity for 1,000 completely unique subdetails nested under every single main account, ranging from 000 all the way to 999.
Exactly. But the sheer volume of accounts isn't the real magic here. The real magic is what that numerical separation unlocks within the database tables.
Because the developers migrated the entire system to this relational 5x3 numeric structure, the software no longer needs to rely on the text description as the primary identifying key.
Therefore, they were able to completely obliterate the old 30-character text limit. The truncation problem is solved instantaneously.
The blueprints note that users can now utilize incredibly long, deeply descriptive text fields.
So that confusing cutoff abbreviation from the legacy system can now expand fully and beautifully into depreciation-furniture and fixtures-head office.
It is perfectly clear, totally compliant with GAAP disclosure requirements, and absolutely no human decoder ring is necessary to understand it.
But beyond just solving the immediate compliance issue, the true lasting value of the 5x3 architecture is future-proofing.
This database is explicitly built for an organization that intends to scale aggressively.
Let's apply this practically to a listener scenario. Imagine you own a successful mid-sized business. You operate out of one primary location. Your main operational expense account is coded as G70,000.
Business is booming, so you decide to open a second location completely across town.
In a rigid legacy system, expanding your tracking might require you to build an entirely new, messy, disjointed set of accounts to isolate the new location's expenses. It clutters the entire ledger.
But utilizing the new 5x3 system, you don't have to touch or rebuild the foundational ledger at all. You simply utilize the relational subaccounts.
Your original location 1 becomes G70,000-001. Your new location 2 becomes G70,000-002.
If you franchise and open 50 locations, the primary reporting structure remains perfectly intact, but the granular tracking scales infinitely.
The blueprints even detail how this transforms asset management.
Yeah.
Because you are no longer fighting a suffocating character limit, you can now input the full 20-character manufacturer serial number of a massive piece of heavy machinery directly into the account description field.
You can track high-value assets with surgical precision right inside the chart of accounts. It completely revolutionizes how a company monitors its physical footprint.
And having that robust, infinitely scalable 5x3 database architecture in place sets the stage perfectly for the final and perhaps most complex piece of the puzzle.
You have built the indestructible shelving unit. Now you have to meticulously organize the actual books on those shelves, which brings us to the complete re-architecting of the USA chart of accounts.
The developer documents outline the newly structured EN-USA chart of accounts in granular detail. They refer to this structure as the financial DNA of the organization.
If the 5x3 database we just discussed is the skeletal framework, the chart of accounts is the entire nervous system.
It is the master map. It tracks, categorizes, and controls every single dollar moving into, through, and out of the business entity.
And to ensure absolute compliance and readability across the entirety of the United States, the developers anchored this map using the traditional, universally recognized USO numbering schema.
And for anyone who interacts with financial reports, the flow of that scheme is the universal language of American business.
The 10,000 block is dedicated to assets.
The 2000 block handles all liabilities.
The 30,000 block is equity.
The 40,000 block tracks revenue.
And the 50,000 block and everything above it handles the various expenses and costs.
The power of that standardized numerical flow is that any external auditor, potential investor, or bank underwriter can glance at a massive trial balance and instantly know the fundamental nature of an account based purely on the leading digit.
It provides immediate structural orientation.
But the 2026 developer blueprints add an alphanumeric twist to this traditional numbering that I found fascinating.
They utilize specific letter prefixes attached to the front of these 5-digit blocks, specifically the letters B, G, and T.
The notes explain that B stands for bank, which makes sense. It instantly segregates highly liquid cash and operating accounts to the top of the balance sheet.
G stands for general ledger, which encompasses the vast majority of the standard operating accounts. But the prefix that caught my eye was the T.
The T prefix stands for template, or more accurately in the context of this specific USA localization, it stands for tax nexus.
And this is exactly where the sheer sprawling scale and complexity of the United States economy hits the software architecture team right in the face.
A massive portion of this localization document, almost 100 pages of the PDF, is dedicated solely to mapping out the chaotic state-by-state tax codes.
Delaware, Montana, California, New York, Alaska. It is a labyrinth of regional taxation.
This is what the industry refers to as the tax nexus challenge. In the United States, as an enterprise grows, expands its digital footprint, and begins selling products, services, or software licenses across state lines, it inevitably triggers what is legally defined as economic nexus.
Once that threshold is crossed, the business is legally obligated to register, collect, and remit sales tax in that specific foreign state.
So to put that in perspective, you could have your headquarters sitting in Ohio, but if your e-commerce platform sells enough product to customers sitting in California to cross their specific revenue threshold, you have triggered nexus.
Suddenly, your Ohio-based accounting team has to flawlessly manage and report on California's incredibly complex localized tax laws.
Exactly. Now imagine a successful enterprise that has triggered economic nexus in 30, 40, or all 50 states.
If the software lacked a smart relational architecture, injecting 50 completely different state tax liability accounts directly into the main general ledger would completely destroy its readability.
The core G operating accounts would be overrun and buried under an avalanche of localized tax data. It would be a nightmare for the controller to navigate.
So the architecture team leverages the T prefix and the 5x3 structure to scale this seamlessly without destroying the core ledger. Instead of cluttering the G accounts, they isolate the liabilities.
They use T23100-001 specifically for California sales tax.
They spin up T23100-002 for New York, T23100-003 for Texas.
It creates a perfectly quarantined, infinitely expandable subledger. It isolates the immense complexity of 50-state tax mapping away from the daily operating accounts, keeping the primary general ledger completely clean and focused strictly on the business's core performance.
It is brilliant data segregation. But dealing with complex data wasn't just limited to taxes. The source material also highlights a highly critical structural fix mandated by GAAP regarding the presentation of fixed assets and their related contra assets.
This was a major flaw in legacy software presentations that the 2026 update directly remedies. A contra asset in this context is accumulated depreciation.
It represents the steady loss of value on your physical assets, like heavy machinery or server banks, over time as they age.
Right. And in the older legacy chart of accounts layouts provided in the documents, the presentation of these two linked concepts was completely chaotic.
The asset cost, the actual historical amount you paid for the machinery, was parked in one numeric block, say the 15,000s.
But the accumulated depreciation, the math required to figure out what the machinery is actually worth today, was banished to a totally different, disconnected numeric block, like the 17,000s.
Which creates a massive analytical headache. It means an auditor or a CFO analyzing the balance sheet has to physically flip back and forth across multiple pages of a report, manually matching up the asset cost in the 15,000s with its corresponding depreciation in the 17,000s, just to figure out the current status of the equipment.
It is entirely disjointed.
It is. And more importantly, it fundamentally violates the gap matching principle in terms of clear, coherent financial presentation.
Concepts that are intrinsically linked must be presented together. The new 2026 architectural blueprint fixes this flaw by by utilizing the 5 by 3 system to physically force the cost account and the depreciation account to sit numerically adjacent to one another.
Let's look at how they map that out. The original cost of the equipment is assigned to main account G15100.
And directly beneath it, inextricably linked by the numbering, the accumulated depreciation is assigned to subaccount G151000001.
The analytical efficiency gained by this one structural change is immense. It means that calculating the net book value, which is the current actual depreciated worth of the asset, is practically instantaneous.
The auditor doesn't have to hunt across the report. They just look at the two numbers permanently grouped together and do the math in a fraction of a second.
It drastically reduces audit time, eliminates manual matching errors, and provides immediate, unclouded clarity for the business owner reviewing their capital investments.
It is all about systematically reducing friction between the human and the data. The blueprints also briefly, but very firmly, touch upon how strictly the IRS dictates the subaccount architecture for payroll liabilities.
Yes, the IRS is entirely uncompromising on this front. The developer notes make it clear that you cannot simply build one giant monolithic liability account called taxes owed and dump all your payroll deductions into it.
The new 2026 structure explicitly, preemptively groups highly specific federal taxes like FUTA, the Federal Unemployment Tax Act, and specific state taxes like SUTA into their own rigorously designated liability ledgers within the 20,000s block.
The software is essentially doing the pre-sorting before the data even settles.
Exactly. It ensures that when quarterly tax filing time arrives, or in the event of an intensive IRS payroll audit, the data is already hyper-organized exactly the way the government agency demands to see it.
The software architecture actively prevents the business from falling out of compliance by forcing the data into the correct regulatory silos from the very first keystroke.
Looking back over the blueprints we've unpacked today, we have covered an incredible expanse of territory.
We started with the deep historical and cultural quirks of spelling colors, with a U in the Canadian modules, to program regional trust and alleviate cognitive friction.
We explored the proven psychological impact of shifting an entire enterprise interface from the legacy of all CKPS to the scientifically superior sentence case typography.
And how capital letters can satisfy both management and the Revenue Quebec simultaneously.
We tracked the fascinating UX evolution behind the massive terminology shift, eradicated the European database translation of PER in favor of the human intuitive functional North American command by.
And finally, we dove into the engine room to see how tearing down a 30-character text limit and upgrading to a relational 5 by 3 database architecture allows organizations to build a clean, infinitely scalable chart of accounts that seamlessly manages 50-state tax nexus and strictly adheres to US GAAP and IRS standards.
What this entire journey through these localization and architecture blueprints really illustrates is that in the realm of enterprise systems, structure is not merely a vehicle for compliance. Structure is the ultimate foundation for clarity.
The specific way you choose to organize your data, the precise cultural words you use, the typographic hierarchy you implement, the mathematical schema you adopt for your database, literally dictates how clearly you're able to perceive your own operational reality.
If your underlying architecture is flawed, chaotic, or culturally disconnected from the user, your understanding of your own business will be fundamentally flawed.
That is a profoundly powerful takeaway. The architecture dictates the reality. But before we wrap up this deep dive, I want to leave you, the listener, with one final provocative thought. It is something that wasn't explicitly covered in the developer text, but it builds directly on everything we have just spent the last hour discussing regarding the future of software.
The ultimate trajectory of all this meticulous localization.
Exactly. We just spent this entire deep dive looking at the staggering amount of resources, coding, testing, and psychological engineering required just to differentiate between American English and Canadian English.
Just to manage variations across one single border between two cultures that share the same foundational language.
But looking forward into the next decade of development, what happens to the architecture of enterprise accounting software when artificial intelligence begins automatically, dynamically translating these highly specific financial concepts across entirely different cultural frameworks in real time?
That is the existential question for software developers and global accountants alike.
We are talking about the capability to translate complex GAAP ledgers into languages that don't even possess a concept of linear time, or languages that don't utilize categorization concepts like per and by in any recognizable way.
When AI enters the equation, Will it eventually force the standardization of a single, universal, homogenized language of global business that completely overrides all these local historical quirks?
Or will it do the exact opposite? Will AI utilize dynamic generation to create infinitely customized, hyper-localized ledgers for every single individual user, adapting to their specific dialect and cognitive preferences, rendering standardized formats and rigid charts of accounts completely obsolete?
It challenges the very necessity and survival of a standardized chart of accounts.
Mhm.
If the system translates the reality perfectly to the individual, the universal standard loses its primary function.
It really does. It is a massive structural shift on the horizon. Definitely something to mull over the next time you pull out a spreadsheet and look at how the columns are organized. Thank you for joining us on this deep dive into the invisible architecture of accounting software. Keep questioning the structures around you, and we will see you next time.